Every organization faces a critical challenge, managing overdue debts while safeguarding financial stability. In this video, we explore the rigorous process of reviewing client compliance with credit terms and planning an effective debt recovery action. Imagine a scenario where delayed repayments disrupt cash flow and threaten the health of your business. Today, we will delve into a structured, step-by-step approach that assists financial professionals, business managers, and credit control specialists in addressing this very challenge. Our journey begins with understanding client compliance. The essence of this task is to identify which clients meet their payment obligations and which ones have defaulted. In a world where every day counts, we learn that client compliance is not just a measure of trust, but the foundation upon which sound business practices are built. Within the first moments of our presentation, consider this. How closely are you monitoring your accounts to make sure that each client's payment behavior aligns with your organizational credit policies? We start by defining the process of compliance review. At its core, this process involves categorizing clients into good and bad. A good client consistently honors their payment commitments. A bad client, on the other hand, either delays or entirely misses payments, causing ripple effects in your ledger. The first tool we rely on is the debtor aging report, an indispensable instrument that lists outstanding debts by the time elapsed since the invoice date. This report not only exposes delays, but also provides insight into the severity and duration of the overdue payments. It is central to identifying clients who are in default of the agreed terms. Once defaulting clients are identified, we dive deeper into the process of segregating them further. Sorting these clients into appropriate categories is the first decisive step towards formulating a recovery plan. It is a methodical approach that distinguishes between those who may simply need a reminder and those who require a more structured intervention. Visualize a flowchart outlining this process, a clear beginning with the aging report, then branching into pathways for follow-up actions, whether they be friendly reminders or more formal recovery measures. Moving to our second act, monitoring and reconciling subsidiary accounts. Within any financial system, accurate and consistent account management is paramount. The subsidiary ledgers, accounts receivable and accounts payable, offer detailed insights into individual transaction records. Here, the emphasis lies in ensuring that every entry in the subsidiary ledger matches with the corresponding entry in the general ledger, thereby eliminating errors and omissions. Failure to perform this reconciliation on time not only creates discrepancies, but may also lead to misleading financial statements that impair your organization's reputation among stakeholders. Reconciliation is often executed during month-end closing activities. By scrutinizing large vendor transactions alongside individual creditor records, you ensure that all financial data is captured accurately. The process is systemic. Check the adherence of transactions to established accounting policies. Accumulate and review supporting documentation, then compile and verify the reconciliation statement. This meticulous review not only upholds the integrity of financial statements, but also provides a clear roadmap for identifying areas where credit compliance may be faltering. As we progress, another pivotal aspect emerges: negotiating debt recovery agreements. When a client falls behind on payments, the next logical step is to establish a clear, flexible payment plan. Debt agreements help navigate the delicate balance between recovering the owed funds and preserving long-term business relationships. They are not instruments that relieve debtors of their liabilities, but rather structured plans that offer deferred repayments under specified terms. Imagine sitting with a client, discussing clear repayment schedules, understanding their financial constraints, and agreeing on mutually beneficial terms. This negotiation often includes key elements such as the agreement date, detailed business information of both parties, settlement amounts, and penalty clauses in case of non-compliance. In this phase, you learn to view debt recovery not as a confrontation, but as an opportunity for constructive dialogue. A well-structured repayment schedule dispels confusion and sets clear expectations, eventually leading to the timely clearance of outstanding debts. The process is incremental and measured. The debtor is given a 2-month window to meet payment deadlines, but when this expectation is not met, the organization's policies guide the follow-up actions decisively. Inevitably, a conflict arises when a debtor persists in default after all friendly reminders and negotiations. This scenario sets the stage for decisive action on breaches of organizational credit policy. Once a payment deadline is missed, it becomes a formal breach if a debtor fails to settle dues as per the agreed terms. The organizational credit policy mandates a grace period, typically 30 days from the due date, to allow for resolution. During this interval, constant communication through phone calls, emails, or letters is essential. The objective is to retrieve overdue payments without alienating the client. However, if the debtor remains unresponsive or non-compliant, even after these efforts, the challenge escalates. It becomes necessary to transition the matter to a more rigorous phase of the recovery process. For example, internal recovery teams might send an official letter of demand, establishing a clear record of default. At this juncture, the situation is fraught with tension as the possibility of legal recourse looms. Think about the pressure that builds when a client knows that their failure to resolve the debt might eventually force the organization to take legal action or involve a debt collection agency. Adding complexity to this scenario is the use of alternative follow-up procedures. In instances where conventional and informal approaches do not yield the desired results, external measures become crucial. Engaging a trusted debt collection agency, for example, is a widely endorsed option. Such agencies employ a range of strategies, ranging from persistent calls and emails to issuing formal letters, to recover the outstanding amounts. Alternatively, organizations may consider purchasing bad debt insurance, a strategy that protects against financial losses while ensuring that the business's cash flow remains stable. The expression "forewarned is forearmed" encapsulates this preventive approach, where timely actions mitigate future financial risks. As we move towards the climax of our narrative, the focus shifts to developing a comprehensive debt recovery plan that integrates all previously discussed elements into a coherent strategy. Here, the process begins with simple, friendly reminder communications and gradually escalates to more severe measures. Consider a step-by-step progression. The first reminder is designed to gently prompt the debtor by acknowledging that mistakes can happen. The second, a more ablative overdue reminder, reinforces the urgency to act. Direct personal contact is then advised for cases where electronic communications do not suffice, and a formal letter of demand is prepared as the final internal measure before legal proceedings are considered. The narrative here is not just a step-by-step manual, it is an invitation to embrace a disciplined, proactive approach in managing credit risk. Each stage of the process reinforces the principle that systematic follow-up through both internal and external conduits is essential for safeguarding your organization's financial stability. The visual aids that accompany this process, flowcharts, reconciliation diagrams, and bullet point overlays, serve as cognitive anchors, simplifying what might otherwise appear as daunting financial protocols. As we enter the final act of our discussion, it is important to reflect on the lessons presented. You have seen that the identification of defaulting clients through debtor aging reports is the critical first step. Monitoring and reconciling subsidiary accounts ensures the accuracy of your financial records. Setting up negotiation frameworks for debt recovery paves the way for amicable resolutions. But when these fail, the structured escalation to legal action protects your organization's interests. Every element, from the initial identification to the final decision on whether to write off a debt, is driven by the same underlying logic, a disciplined, systematic approach to debt recovery. The resolution of this conflict lies in the clarity and discipline of your processes. Whether it's sending timely reminders, initiating legal measures, or resorting to external agencies, each step underscores the importance of adhering to organizational credit policies. Upholding these policies not only ensures smoother operational efficiency, but also shields the company from significant financial losses. The process we discussed is not without its challenges. It requires diligence, regular review, and sometimes tough decisions. Yet it is these challenges that emphasize the true value of a comprehensive debt recovery plan. Before concluding, let us reiterate an essential point. Every day is critical in managing overdue debts. The longer a debt remains unsettled, the greater the risk to your organization's liquidity and working capital. This video has aimed to arm you with the knowledge and actionable steps necessary to address these challenges head-on. By maintaining strict adherence to your credit policies and leveraging systematic follow-up procedures, you create an environment where every overdue debt is treated with the urgency it deserves. In wrapping up, remember that the process of debt recovery is a critical component of financial management, one that can determine the long-term viability of your organization. With clear processes for identifying defaulting clients, reconciling accounts, and negotiating payment plans, you are well equipped to mitigate the risks associated with delinquent accounts. Moreover, by wisely employing external measures such as debt collection agencies and bad debt insurance, you can further safeguard your financial interests. We encourage you to apply these strategies consistently. Regularly review your organization's credit policies and analyze debtor behavior using aging reports. Develop and implement structured recovery plans that not only minimize losses, but also foster continued business relationships. In doing so, you not only overcome the immediate challenge of overdue debts, but also contribute to the overall financial health and stability of your organization.